Hi, I'm Owen, the host of the Australian Finance Podcast. This podcast is proudly sponsored by Betashares, one of the leading providers of ETFs here in Australia. Serving thousands of financial advisors and over 1 million investors, Betashares manages tens of billions of dollars on behalf of investors right across the country. I'm proud to partner with Betashares on the Australian Finance Podcast, Australia's premier financial podcast, because there is great alignment in the long-term philosophy shared by both businesses. I hope you enjoyed this episode of the Australian Finance Podcast. Hugh, welcome back to the podcast.
Thanks very much, mate.
Today we're talking stocks, US stocks, otherwise known as shares, otherwise known as equities, otherwise known as a bit of fun on today's show. So we're going to bring 3 stocks each to the podcast and 1 ETF, which we'll get to the ETF last. But to mix things up, you've been on the show before. You talk a lot about technology, talk a lot about US shares and investing generally. We're going to talk about these 3 companies that you've got, I've got, and then we can let the community kind of score us, so to speak. Okay? Does that make sense to you?
That makes sense to me, yeah.
Yeah.
Ready to go. Excited.
So we hear a lot of these stories about entrepreneurship emanating out of the US. And it's kind of like people are rewarded for starting these wonderful companies and growing them. There's not as much tall poppy syndrome. So we've got a very fertile hunting ground over there. Now, what I'm thinking we can do is kind of like maybe like an I go, you go type of thing. And then the community and listeners, viewers can leave notes for us in the comments and maybe say, hey, come back and talk about this company or come back and talk about this ETF. Or just give us a score, maybe like an A+, which is probably what Hugh's going to get. And I'll probably get the P. I heard a bit of a joke that podcasters get P's, almost like the P's get degrees type thing. Just make and do. So my 3 companies, I can tell you at the outset, are Pepsi, Intuit, and Adobe. All right, what do you got?
Right, so my companies are Broadcom, Palantir, and Netflix.
Okay, cool.
So those are my 3.
So you've kind of got a bit more technical type companies, which I'm hoping you can break down. Now, do you want to go first or do you want me to go first?
Happy to go first, Owen.
Okay, cool. Yeah. So what are we going to launch with?
Yeah, so we're going to launch with Broadcom. So that's the first company I mentioned. The reason why I mention it is it's probably a company that many of your viewers might not have heard of, but it's the 7th largest company in the US. And when I mean by that size, it's $1.3 trillion. Dollars in US market cap. So it's a really, really big company. And I guess how I kind of explain this is business. It's in the semiconductor industry, similar to what NVIDIA does and the Magnificent 7 does. Yeah. I guess how it differs is, how the Magnificent 7 purchases NVIDIA chips to put in their data centers. Broadcom provides a similar chip, but it's what they call custom ASICs. Now, what ASIC stands for is application-specific integrated circuits. So it's a bit of a wordful, but what it effectively means is, if there's a certain task that you had to do every day, that's, a good analogy is your washing. You have to do it every day. It's very high volume. It's monotonous. Yeah. These custom ASICs are purposely built for those repetitive tasks. And in this world of technology, that's often in machine learning and training these new AI models. So a really great example is with Google's TPU, which is a tensor processing unit. Effectively, Google designed it and Broadcom made it. And so that Google TPU trains this machine learning model. And so all these apps on your phone, such as Google Photos, Google Search, Gemini, Google Maps, etc., they're all powered by the machine learning algorithm that this custom ASIC has helped produce. And so that's where Broadcom's business has really, really excelled. So that's the first part of the business, the custom ASICs. And then the second major part is what they call infrastructure software. So over the past 7 years, Broadcom has made this string of acquisitions. They acquired Symantec, CA Technologies, and VMware. Now, what they effectively do and why Broadcom has done this is really to provide a cloud software system where enterprises can put their data obviously on the cloud, but in a secure way. So VMware has a lot of security solutions to do that. So you combine those 2 things, those custom ASICs and then the security software solutions, that's really the bread and butter of what Broadcom does. And it's really excelled. As I mentioned, 7th largest company in the US.
I never would have thought that.
Yeah, so that's my company. Again, probably not as well known, but it's a new Mag 7, I would say.
Wow, I did not. Yeah, I for some reason, like, I reckon we've spoken about Broadcom properly like once on the podcast, all podcasts at Rask in the 7 years that we've been doing them, and yet it's massive. When you think about it, if you go like 5 years ago, to say it was $1 trillion would be enormous.
Absolutely, yeah. This company is huge. Like, to cross $1 trillion. I mean, just to give viewers a bit of context, the Australian stock market is around $2 trillion in Australian terms. So it's nearly the size of Australia. It's bigger than Tesla. And it's probably eyeing down some of the bigger companies in the Mag 7 as well. Not there quite yet. I mean, the other ones are at 2 trillion, 3 and 4, but it's definitely growing fast. And, you know, as all the spending continues, Broadcom will likely benefit. So, I mean, there's a really good stat that AI is expected to drive over 40% of its revenue next year. That's a huge amount. And I guess in terms of where the business is going to go from here, you got to really look at where that AI demand is coming from, but also where the security demand is coming from as well.
Wow.
So, that's Broadcom in a nutshell.
I like it, mate. And thank you. That's a great business, which we can refer back to at the end of the show. So I think I'll start with Intuit. So people may be familiar with accounting software like a Xero in Australia. I was a long-time shareholder. I still own shares, but not directly. I own them through ATEC, which is the Betashares ETF, which has a big holding in Xero. So having that ETF to hold Xero is fantastic because I've got like WiseTech and all these other businesses. So for people that don't know, cloud accounting software is the frontier still today. In the past, what would happen with accountants is they would have to get all your bank statements and reconcile manually, either in a spreadsheet or before that, manually in like graph paper kind of thing. They would have to get the comings and goings of the money in a bank statement to then form what they call a general ledger, which is just a bank statement, but it's like, what's the money going out? What's the money coming in? And they just kind of reconcile that. And over the last 10 or 15 years, what's happened is a lot of the software has replaced those manual and repetitive tasks by using machine learning and those types of things where they can just read the bank statement, connect in, and produce like a profit and loss statement for an accountant. Or the bookkeeper can just go in and make a few tweaks. And a good example of this, like, as you'd know, Hugh, if you drive a car and you go to BP service stations and you fill up once every fortnight, the software would automatically know that that's fuel, and that would be categorized by the accounting software somewhere. So it makes accountants' lives really easy. It makes the client, who is a business owner or an individual, really easy. And Intuit doesn't just do QuickBooks anymore. The QuickBooks that we know here in Australia is very limited. And some said that the only reason why QuickBooks launched in Australia in the way that it did recently was to see if Xero could defend against it. And Xero did, obviously, and won. And so it was almost like a test by the Intuit board to be like, are we capable of defending against Xero? And they have been able to defend in their home turf. So most of Intuit's business is in the US and Canada. And it has not just QuickBooks, it's got TurboTax. But the big one that people probably aren't aware of, it owns Mailchimp. So Mailchimp is rumored to control about 51% of all email marketing in the world, which is humongous. I mean, that's probably the world ex-China, because I'm sure they don't allow that there. But Mailchimp, for people that aren't familiar, has that little monkey at the bottom of emails. You've probably seen it before.
Yeah, I think I've seen it. Yeah.
I often joke that businesses start with Mailchimp. That's how you know the business is new. Because they all just go to Mailchimp because it's the biggest, and then they realize there's alternatives. But in that world, you're competing against Salesforce. You're competing, some extent, you're competing against ActiveCampaign, Klaviyo, and all these other wonderful businesses in their HubSpot, etc. But what Intuit did is it brought them together so you could have kind of like email automation, CRM automation with your accounting automation on the back end. So you have both together. Intuit is a $187 billion USD company. My number's here. That makes it $282 billion in Aussie, almost exactly 10 times the size of Xero.
Wow.
Yeah. So I bought Xero shares in, I think first time I bought them was like 2014. And I remember saying at the time, nothing can beat Xero.
Yeah.
What I should have done here is I should have bought both Intuit and Zero.
Zero.
Yeah. There's some crazy number which people are blown away by. This is since it was listed in 1993 until today, Intuit is up 25,000%.
25,000%. That's an insane number.
Yeah, it is. So it blows people away, and yeah, it's just like a hockey stick. But basically the big move by Intuit is, like a lot of these tech companies that you just mentioned, not quite at Broadcom level, but it's how do we use AI with the data that we have on our customers to make their lives better, make their tax returns easier, make their business decisions faster and more accurate. And that's the big play. And that's how it's going to add value in the future. It's going to take all that data that it controls and then run it through AI and basically present things to people. So that's my first company's Intuit.
That's awesome. I mean, there's been a lot of concern about AI replacing accountants, but it's almost an enabler, and you can see it through the growth of these businesses. Like if you can actually integrate AI within your business to streamline efficiencies and produce more out of your given time in a day, then you're producing value. So no, that's a great example.
Yeah, thanks, mate. Appreciate that. That's a high praise coming from you. Just as an FYI for people that aren't familiar with Broadcom, it looks like, I could be wrong here, just going by Google Finance, IPO'd 2009, so GFC, at $50 odd, $60. It's now $300. So excluding dividends, it's up about 18,000%. Long-term hold there, that would have been fantastic, but wonderful business as well. Now, did you want to jump into number two?
Sure thing, yeah. So my number two is Palantir. It is in doing something similar to Intuit in terms of you've got all this rich data load, and you're applying AI to make sense of it. But Palantir has really been a popular stock, particularly for those who are a bit more immersed in the investing world, I would say.
Yep.
Palantir is a $370 billion company founded by Peter Thiel, who's also founder of PayPal in the past. And really what Palantir is, it's really benefited from the confluence of AI and defense, which have been really dominant themes in 2025. So what does it do? Palantir is at its heart a software company. So it sells software to clients. So who are those clients? There are really two sort of channels in terms of their client segments. The first one is in the government sector. So over half of their revenues come from government entities. So they include particularly defense departments. So the US Army, Department of Defense, etc.
Yep.
Now, the US Army actually signed a $10 billion contract over the next decade. And that's going to equate to obviously $1 billion in annual revenues for Palantir. So it's a really huge amount. And it just goes to show, like, you know, Palantir has been benefiting from the rising geopolitical tensions that we've seen in markets this year. I mean, to give you a few examples, they have two sort of offerings. One is called Titan. Sounds pretty cool, right?
Yeah.
So it's effectively like a mobile ground station, and it will analyze data in satellites and send those signals back to the military base on ground, so they can effectively plan their operations a bit more efficiently. And then second is one called Maven. Maven is effectively a generative AI tool. It helps commanders really process all of this information, make decisions faster, and again, execute a bit more efficiently as well. So as AI is helping Intuit, it's also helping Palantir scale extremely quickly and also benefiting from this geopolitical environment that we're seeing ourselves in. Now, the second sort of segment is their commercial clients. So in addition to the Department of Defense, the US Army, they have clients across, consumer staples, finance, etc. So Walmart is a good example. Again, they've got a lot of data and selling them software where they can really visualize it, make sense of what their data is telling them. Has also been an attractive point for Palantir. So it's not all defense, but in the media, it's been viewed as a defense tech company. So Palantir is my company. Now, there's been a recent pullback in its share price, a lot of concerns on valuation. So it's currently at 70 to 80 times forward PE, which is an insane amount. But in software, there's a metric called the rule of 40. So for people who don't know what the rule of 40 is effectively if you combine your revenue growth rate to your operating margin, if that's above 40, it's considered good. in software.
Yep.
So for Palantir, that's at 94%.
Wow.
So some bullish investors who are long-term believers of Palantir are saying, well, because they are significantly above this 40 level, despite the 70 to 80 times forward valuation, then the stock price is justified. Of course, you have people on the other side saying that's just outright too expensive. But I'm just here to sort of appreciate where their business has come from. Like year to date, their stock price has more than doubled. Yeah. Which is an insane amount. So Palantir is the second stock.
I like it. So there's a few things. I've always studied Palantir from afar because I remember you would hear software engineers talk about Palantir, but they were never allowed to really truly talk about it until it IPO'd.
Yeah.
It was always really secretive what they did, who their customers were. But software engineers would have to work for them and they would know what Peter Thiel was doing and stuff.
Yeah.
Fascinating company. But a lot of people, I actually met someone recently who had only bought one stock since they started investing, and it was Palantir.
Right.
And it was last year when it was about, I think it was about $10. It's 150. This is 2023. Sorry, about $10. And now it's 160. Like, it's maybe
insane.
not meme stock because it's actually a good business.
Yes,
but it's but we can admire that business from a distance for now. That's super cool.
Yeah,
I like it, mate. Great work. Well, speaking of pullbacks, this company that I wanted to bring in next is Adobe. Which I was chatting to Monique off camera just over there before. There is basically no alternative to Adobe. In the old school language, they might call it a virtual monopoly because there's only one provider that does basically everything, and it's like that can lead to competitive issues. But for any of the creatives or even people that have heard like Photoshop in the past, you could just Photoshop it, became like a verb. This is the business behind all that. Adobe Premiere, Cloud, even the more recent acquisition, which I thought at the time was pretty wild, which was Figma. They bought Figma. It's another design tool. But basically our business runs on this, Hugh. Our business runs on Adobe and Canva. I realized the other day, I don't know if this makes me sound out of touch, but it's just a reality. We're spending approximately $13,000 a year on Canva.
Wow.
So it may be a mistake on my end, but anyway, it is what it is. And I'm sure like Adobe is probably cheaper than for just hopefully Monique's like shrugging her shoulders like maybe. But it's expensive, right? Once you start to really use these pieces of software and they increase prices and what have you, wonderful, wonderful business. It leads itself to higher rates of recurring revenue because it's all sold through subscription. Interestingly, one of the reasons that they did do a big pivot to subscriptions is actually because of pirating. So in the past, people could share like logins. People would pirate things, particularly in China. They've ran up against this issue. But more recently, switching to the cloud has meant that it's like everyone's got their own subscription and they can get more from enterprises basically. So really predictable business. Revenue is really interesting because it just kind of scales. I do have some numbers that I'll throw at people in a minute. But recently, it's fallen from $600 a share to $360 a share. But that's okay because since 1986, I think it is. 1986, it's only up 165,000%. And that's the real number. So absolutely wonderful business. Some of the data that I have here, I'm just going to bring this up, is $154 billion company. Its gross profit margin, so this is what you charge minus the cost to actually deliver the thing, is 89%.
Wow.
So
huge. Really high,
huge profit margin. Then the last company that we talk about will not be that. So it's return on invested capital. This is the one that all basically analysts follow. Return on invested capital, which basically means if you had $100 inside Adobe and you're the CEO and you invested in something within the business, what would be the return you get? So not the share price return, but the actual return on that money that you put to work, 46%, which is incredibly high. And it just all speaks to the quality of this business. I think one of the big fears is like, how does Adobe respond to AI? How does Adobe respond to all of those different things that are coming? Like people know you can jump into ChatGPT and you can say, hey, create me a photo of Donald Trump with a chef's hat on or something, and it would do it, right? Whether or not it's that good, but that's an example of where maybe people's fears are coming from right now. But overall, a wonderful, wonderful business, Hugh.
Great. Yeah. I mean, I've heard similar sort of worries about AI taking over Adobe, and I think that's probably a reason why it's explaining its pullback in its share price.
Yeah.
I think they also have a tool called Firefly, which is another AI offering within their business model. So if they can hopefully integrate that, and actually monetize that, then that could be another revenue driver. So.
Yeah. And the thing is, it's like you said before, an enabler. So I think that there's going to be a big shift from, people just doing basic things to doing more advanced things by using the tools, not necessarily by replacing a job. It's kind of like, there was a great analogy with Seth Godin on a podcast. Seth Godin is the author of Permission Marketing, Purple Cow and all that. And he talked about how back in the day when the iPhone was basically invented, people at weddings would always take photos, right? And photographers at the time were a bit upset. They were like, well, if everyone can take photos, why am I here? You know, the professional wedding photographer. Yeah. But then he came out with this line, which I absolutely love, which is the pros don't fear the amateurs. And basically what he meant by that was, other people are taking photos, but you're the one that's taking the professional photos, and you've got better because you've got better tools. Yeah. And I think that's an example of here where the pros don't fear the amateurs. People that use Adobe will keep using it. And I think that that's going to be the case for the long term.
That's a good point. Yeah.
So that's number 2 for me. You're down to your lucky last.
Lucky last, yeah. And I think most people would know this one. This one is Netflix. I hope so. Yeah, so Netflix, $510 billion US company. Yeah. Netflix is a entertainment streaming company. So if you are a reality TV fan, Love is Blind, perfect match. I'm looking forward to Alice in Borderlands next month. Yeah, so it's like a Japanese sort of horror-esque game TV show. So anyway, so that's Netflix. So I'm sure a lot of your viewers know what they do. So how you make money from Netflix is if you've got more people on the platform paying money, then naturally you're going to increase your revenues. But it's a little bit more nuanced than that. So in terms of what they offer across different geographies are different sort of plans. You can pay for a plan that has ads or no ads. They recently launched the one with ads in late 2022. And the whole idea was really to expand Netflix's offering beyond sort of developed markets and probably into more price-sensitive countries in emerging markets. So they're generally a cheaper option. You do have ads in it, but we've seen an incredible take-up in the ad-supported tier. So there's more than 90 million memberships within that tier. Yeah. And just to give a bit of context, in Netflix's overall business, there's more than 300 million people who are subscribers. So there's already a substantial amount in that ad-supported tier. So, I mean, beyond sort of that core revenue driver, they also make money through strategic partnerships. So they partner with technology companies that have smart TVs. So think of your Samsungs, your LGs, they come with Netflix within it, the TV, and they're usually like a Netflix button, so you can get straight into it. Yeah. And also telco providers, because you have to sort of deliver that content to individuals looking at that content on their television screen. So you've got a few factors there. But similarly, like AI, everyone's talking about AI. How is AI, I guess, helping Netflix, or is it not? I think there's a lot of concerns. Firstly, I just wanted to address on Netflix's engagement being, I guess, in competition with YouTube. YouTube has been a core sort of like competitor with Netflix, as with Disney Plus, Hulu, etc. But I think where AI can really help Netflix is, well, firstly, you've got a huge database. You can personalize your recommendations for your viewer. So everyone's Netflix is very different. If someone watches reality TV, then it's more likely to suggest Perfect Match or Love is Blind, etc. Right? So that leads to more engagement and hopefully higher retention. But the other sort of thing is AI, it can reduce some of the costs in producing content because similar to what Adobe does, well, I mean, AI can generate images. You can also generate sort of animated content. And hopefully that can reduce a large cost for Netflix in terms of producing content. And then thirdly is ads. I mentioned that ad-supported tier. You can make ads a little bit more applicable and tailored for each sort of viewer. And again, you can generate sort of ad revenues through that channel as well. So yeah, I mean, Netflix, again, great business, has done extremely well. few tensions and concerns around competition with YouTube. But I think longer term, AI can really help drive this business going forward because it has such a unique, rich database that is effectively its competitive moat to other entertainment streaming companies.
It's really interesting, isn't it? I remember when they launched that advertising package, and I was like, because you look, when you're an investor, you look at the whole business. When you're a consumer, you just look at what the product is. But I remember when they launched that, because they were like, well, we want to expand into India. We want to expand into these other markets, and we can't charge $15 US a month because that's a lot of money. Right? So you've got to find some other way to do it. And they've done such a good job at that. It's incredible. I remember the big fear was after COVID, if shares fell from $600, 660 down to like 170, which is a huge fall, and it's all the way back up at $1,200. There have been so many opportunities to buy Netflix over the years. We use Netflix internally as like a case study, Hugh, because it's evolved from mail out DVDs to getting on the internet to mobile to in-house content to now it's got video games as well, and now it's got ads. Like, it does so much. But here's an interesting statistic for you, which blows me away every month. Our video versions of our podcast, 35% and rising, is viewed on a smart TV.
Really? Wow.
Yeah. So
That's
this
incredible.
podcast today, 35% of people, hello through the camera, will be watching on a smart TV, which is huge. So they watch it via YouTube or something like that, which is wild.
Yeah.
But like, it's just a sign that free-to-air television and all that has changed substantially. So my last company is actually a company that I know the least about in terms of its actual business models, because it does so many darn things that I've just been trying to keep up over the last 24 hours. But the company is Pepsi. And these are the beverages that it makes: Pepsi, Gatorade, Mountain Dew, Aquafina, Tropicana. Those are just some of the names, right? Which you probably know.
Yeah.
The other one is that people don't really know is it actually makes Quaker oats.
Yeah, okay.
So that's the one.
That's why you mentioned it.
Yeah, that's what I mentioned. Yeah.
I was like a bit confused.
Yeah. So Tostitos, Ruffles, Lay's, Doritos, Cheetos. This is PepsiCo. So it's just an absolute monster in your pantry, and you don't even realize it. I think you guys said here at Betashares HQ, there's Pepsi.
A few Pepsi cans in the fridge.
Yeah. So Pepsi's here.
Yeah.
I got to admit, I am more of a Coke Zero type of person, but Pepsi's done a wonderful job over the years, and I actually found this really interesting data. So it's a $200 billion company. So it's a monster. Like Woolworths is 44 billion Australian. So it would be like 8 times the size of Woolworths. But you can actually buy PepsiCo shares on a valuation that is approximately 1/3 of that of Coca-Cola. So even though Coca-Cola exists and it's a really powerful force, Pepsi has done a wonderful job of growing its business. One of the best performing stocks that I've ever come across, and this might shock people, is Monster Energy.
Right.
You know, like the drink?
Yeah, energy drink.
Yeah. The 3 kind of like things.
On the can,
Yeah, that is one of the best performing businesses anywhere, right? And it's like a branding and soft drinks business. Pepsi and Coke have done a wonderful job of just creating a duopoly. It's much the same in beer and these types of things, like Asahi and those types of brands do a wonderful job of just gobbling up good brands. We see it in luxury goods as well. The business has a bit of debt. I was just reviewing that beforehand. It has cash on its balance sheet. It's profitable. It's a good business. Pays a generous dividend. I think based on my data from before, it was around about 3% dividend yield. So you get all of that in this long-term growing business. It compounds, like its sales grow at about mid to high digits every year. So it's not Adobe. It's not a Palantir, but it's a business that is always been there and continuously will be. So that's PepsiCo.
Great. No, great story.
Now, Hugh, we've covered Adobe, PepsiCo, Intuit, Netflix, Palantir, Broadcom. We're here to say today, you're an ETF guy, right? You're an investor, but you're an ETF guy, right?
Absolutely. At the heart. Yes.
Yeah. So we wanted to bring all of these exciting businesses to people so people's imagination can be captured. And in the past, that's what a lot of people did, and they had only the option of going to buy the shares. But now they can do it through an ETF. So what ETFs could they use?
Sure. I mean, there's a lot of ETFs you can use, but for these 6 stocks, the best one is the Nasdaq 100 or the Betashares Nasdaq 100 ETF. The ticker for that is NDQ. It's one of our flagship ETFs. Phenomenal in terms of performance. So it recently hit its 10-year sort of birthday, and in terms of returns, it's exceeded 19% per annum, which it makes it one of the best performing global equity funds in Australia over that period. So again, it's also close to $7 billion in assets under management. So one of the largest ETFs in Australia as well. And again, it has access and it gives investors exposure to all of these great companies, but in addition to 94 other great ones, which are growing, quite fast as well. So again, Nasdaq being a great fund and has also returned, a lot of wealth for investors. We recently did a study actually that showed, of that $7 billion, about half of it, or $3.5 billion, was generated in returns for investors. So that's actual wealth that has been created for everyday Australian investors on top of the money that they have put into the fund. So again, we're extremely proud of that. And that's really our goal at Betashares. It's really to democratize access to investing. You mentioned, typically and historically investors were purchasing single stocks. Again, it's very difficult to pick the winners, and if you can just purchase the basket of stocks that holds these winners, then again you can get really great outcomes, and I'm glad that NDQ has done that. I mean, a few other ETFs include Armour, which is our global defense company. I mentioned that because Palantir is one of the top holding stocks within that portfolio. And yeah, I mean, there's a lot of other great companies in here as well. So yeah.
It's one of those things, isn't it? Like, I remember I used to have a Charles Schwab account, which is a good broker. It was actually a fantastic broker. I loved it. But I just wasn't trading US shares as much. Like, I was just not, I still wanted US shares exposure, and I wanted to own these massive companies, amazing companies. I just didn't want to keep having to fill in W8 Ben forms, having to deal with the currency. And I loved it, and I made probably good money, it's fair to say. And I could see myself still doing that in the future. But for the core of my portfolio, it just makes so much sense. So I wanted to ask you, for people that are like, so they like the ideas of Adobe or Pepsi and these types of things. Yeah. All of these companies are inside NDQ, right?
That's right. Yeah.
What would you say to someone who is like, well, I could maybe buy these individual stocks and maybe they do better than NDQ? Like, what would you say to those people? Yeah,
I think it's a valid question. I think firstly, it is very difficult and time consuming to do that sort of analysis in order to pick the stocks that will perform better than Nasdaq. So as I mentioned, 19% over 10 years, like that's an incredible figure. Huge, so in order to beat that, again, you need to know these companies inside out. You have professionals called equity research analysts who do this day in and day out. They meet with the companies, they write notes, they do valuation models in order to get a really rich understanding of said company. And imagine doing that for 6 companies. It is a lot of time and effort. I mean, some people enjoy the thrill of individual stock picking. But again, it historically has been proven like it's quite difficult to pick the winners, unless, you really know what you're doing. So that's sort of what I would say. I mean, ETFs, again, the real benefit of it is, as we know, diversification. By holding that basket of 100 companies as opposed to 5 or 6, you can really spread out any individual risk assigned to one company. So that's another benefit as well.
Yeah, that's a good point.
From performance,
Yeah, because a lot of people talk about diversification here, and they talk about it from the perspective of spreading risk. But one of the things that they don't talk about a lot, and us as an industry don't talk about, and there's some data on this, there's some good websites, I think it's called efficientfrontier.com, talked about this a bit as well, is that diversification is not just about risk, it's also about the risk of not picking winners. So when you think about diversification, everyone says, no, don't put all your eggs in one basket. They normally imagine someone tripping over with a basket in their hand and all the eggs crack or something, right? But another way to think about this, and this is for everyone that's listening, is diversification. Let's say you back Netflix in, and you're like, Netflix is going to beat YouTube. And then everyone's like, well, YouTube's pretty good. I'm using that more and more and more. I'll give up my Netflix subscription. In 5 years from now, we could have said, well, it was obvious that YouTube was going to win, right? Yeah. So by not having some YouTube / Alphabet, which is the parent company, you actually didn't get the returns from that, So I think that's one of the salient points of diversification is having different levels of exposure to different companies. And through its design, ETFs like NDQ automatically weight to the biggest companies like Broadcom. Like a perfect example, Broadcom before. This is the second, I'm going to guess it's the second time we've ever talked about Broadcom in like 7 years.
Yeah.
And yet it's, what did you say,
seventh largest company in the US.
Seventh largest, right?
Yeah.
And it's been on an absolute tear recently in terms of the share price. That was not on my radar, right? So if it wasn't for ETFs, I couldn't ever have found that. So
that's right.
That's a really good benefit. And I think that what we wanted to do today and what I wanted to do, Hugh, was make sure the people that listen to the show watch it today. If you're on your TV at home, welcome. It's just to say, you can probably go and do all that sort of stuff. You can buy individual shares in your satellite and do all that. But for the core of your portfolio, get that rock solid exposure.
Yeah.
And I think that's probably the core messaging that I want today.
I mean, the only sort of final messaging, and I think that's quite salient to mention, is that, these sort of companies are becoming increasingly interconnected. Like, they're having their supply chains meshed together effectively. So I mentioned Broadcom designing chips for Google. Google buying chips from NVIDIA as well for their data centers. So these are all companies within the NASDAQ ETF that I mentioned. And then you have all these beneficiaries that are using these very AI models to enrich their own businesses.
Probably like Intuit.
Intuit, for example, yeah. So, I mean, whether you like a single stock or not, when you hold a basket, you're holding a narrative, you're holding a theme that can play out over time. So that's the only other message I would mention.
Okay.
Yeah.
People can go and view the full list of holdings inside the NDQ ETF by heading to betashares.com.au. Very grateful. Betashares is a long-term sponsor of the show, but also very grateful that the ETF exists because, like you said, $3.5 billion was created for end investors by holding this ETF for the long term, and it continues to perform well. The companies inside it are amazing. Real quick, though, if I asked you to pick like one of these companies to go and research, and you could pick one from my list, which one would you go and research? I'm just curious.
To research, I would pick Broadcom. Maybe.
Broadcom,
I say Broadcom just because, again, it's such a big dominant player within just the market in general, but not many people understand it. And I think what it's telling the market is that ascent in Broadcom's sort of share price and its market cap is telling investors that semiconductors, the technology economy is the forefront of our economy. It is what's going to drive us forward. And, we're using computers here. Your viewers are going to watch this on smart TVs. I've got my latest, Apple iPhone. Technology is definitely a 21st century innovation. So that's what I would suggest.
Yeah, cool. Like it. Amazing. Broadcom, NDQ ETF. Hugh, as always, it's been heaps of fun. So thanks for joining me.
Thanks, Owen. Appreciate it.
Thanks for watching this episode of the podcast. If you want to hear more from us, you can get daily videos and podcasts on Rask's YouTube channel. Or if you want to enroll in a free course on investing, property, business, money, you name it, you can join over 34,000 other students and enroll in a free course on the Rask website. Simply head to www.rask.com.au and follow the prompts. Thanks for watching this Rask podcast.